So what I'm hearing, Dave, is we're in a recession. Okay, rates are going down, prices are going down. What's next?
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm a level 2 mortgage agent. I'm joined, as always, by David Warren, level 2 mortgage agent, owner at Referral Mortgages, amazing human being, #1 Jays fan, and we're back. I just want to give a quick shout out to our amazing sponsors, Gertin Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. If you use the promo code TOREP, you get 20% off each and every order. EasyNeonSigns.ca. David, how you feeling today? What's going on?
Effing fantastic. We're going to the World Series, baby.
Back to 93. Let's go. Hey, game
32
7,
years.
8th inning dinger.
32
What a game.
years. 32 years. Not since I was 9 years old.
Yeah, that
Freaking
made me
ridiculous.
feel really old. My son, Madden, and I were watching the game last night, and he's like, oh, the Jays haven't been to the World Series since in 32 years. I'm like, it's not true. I'm like, it was 93. And I'm like, oh, wow, I'm old. That's basically what it came down to. Like, well, that was 32 years ago. I remember the baseball caps at Dairy Queen, you know, like the baseball, they had all the different team hats at Dairy Queen. Anyways.
I still
We're
actually
old.
have the Coca-Cola cans unopened with the World Series logos on them and everything from back then.
There you go. Yeah. So big series coming up. Big weekend this past weekend as well, Dave, for the mortgage industry. The Mortgage Professionals Canada National Conference was held here in Ottawa. I know there was some amazing speakers, some great events, and Benjamin Tall, who's the chief economist at CIBC, had some really interesting updates. I'll pass the mic to you, Dave. Let us know. What's Ben saying? What's Mr. Benjamin Tall telling us?
In short, that we're in a recession.
Okay, nice.
Benjamin Tall, he's the deputy chief economist with CIBC. He does kind of consult with the federal government, with the Bank of Canada, and so he does have a focus. He's brought in a lot of times for a lot of these conferences because he does have a focus on real estate and really well and very knowledgeable in that realm. As opposed to some economists where they know the realm, but they're not as equipped or as knowledgeable of kind of diving into the numbers a little bit more as far as how the impacts of what's going on in the economy directly relates to different markets and things like that in Canada. So we're fortunate enough to have him in Ottawa for the conference. And you know, he's saying that technically the GDP hasn't hit that definition, but because the per capita numbers have us in a recession. And he said, especially in markets of Ontario and BC. So predominantly those two markets, which obviously of our figures of population, you know, Ontario's makes up 14 to 15 million alone. So, you know, predominantly large size and a big chunk of that being obviously in Toronto and all of it being down that kind of 401 corridor. So he pointed to weaker consumer spending, rising unemployment, a housing market that's frozen in major cities. You know, he's saying the condo market in Canada, especially in Ontario and Vancouver, are especially hit. Obviously, we've seen that and we've talked about it in the past and showing signs of being in a recession with regards to that. But he kind of commented that, you know, low-rise housing is holding up somewhat. So in all of those markets, that they're somewhat holding up, which again, we've talked about it as well. But, you know, he said, it's not great for the low rise, but it is, but it's okay. And really kind of, you know, it's something that you hear about a lot of places and a lot, you know, we've talked about it before, but also a lot of commentary of, you know, a lot of the buildings being built are, you know, condos in some of these major cities, which are outrageously small. And so it's kind of like, you know, what sort of family dynamic are you trying to target? And so, you know, we're kind of finally seeing that kind of come down as far as that demand on the condos, and more so on the low rise, kind of stabilizing it. So the, you know, houses are too expensive to buy and not expensive enough to build. He called for immediate policy changes and responses. He was speaking about, you know, the first time home buyer, we talked about at the beginning of the year, they had removed for first time home buyers on new construction GST, HST. But he's really pushing for it to be removed for all home buyers, to really kind of stimulate demand in that realm of things, kind of leveling the playing field, if you will. He kind of touched on home, 10% of homeowners renewing in 2026, and that some could see their monthly mortgage payments rise by 50% if rates stay elevated. I don't think that's, yes, if they maintain on the same trajectory of amortization. We've talked about in the past of people coming up for renewal, that there are other tricks that you can do of re-amortizing out, kind of going with that longer amortization. And then if you wanted to, then to lower that have the lower obligation, but then, maybe increase your payments voluntarily, but kind of keeping yourself within that same budget realm. So that I think, he's not touching on those tips of ways in which you can keep that, but kind of by and large of where things were elevated.
Something I've been seeing, just touching on the renewals. So I noticed you'd mentioned him urging a reduction in the Bank of Canada key interest rate. So I think that's very interesting because, historically speaking, and we've talked about this obviously many times, but historically speaking, variable rates are typically lower than fixed rates. And for the last probably 2.5, maybe even 3 years now, we've seen the variable rates be much higher because of this uncertainty with the overnight rate and the economy and so on and everything that's happened over the last, say, 5 years. But what I've seen recently, especially with those renewal conversations, where I'm now dealing with, and I'm sure you are too, but people that are kind of in that 189 to 199 range. So, they're slowly starting to creep up from the kind of 1.5, 1.6s that we were seeing, but still obviously below 2%. A lot of these people that I'm talking to have actually shaved years off their amortization because they have proactively increased their payments starting a year or two ago to kind of allocate those additional funds already to what they anticipate the increased payments will be. Most lenders will allow you that kind of 15 or 20% prepayment, meaning that you can increase your monthly payments by 15, 20, in some cases even 100%. And that extra amount goes directly towards the principal balance. So I had some clients that I dealt with 5 years ago that took a 30-year amortization. They're coming up for renewal. They're down to 20 years and 2 months now because they've kind of overpaid that mortgage, knowing that when renewal time came, their rate was going to be much higher and those payments wouldn't be going as much to the principal balance. So I found it interesting. There's 2 or 3 clients I've spoken this week that have all been kind of doing this. And this wasn't, I would love to take the credit for advising them to do that, but this was just something that they did based on maybe the fear of the expectation of that increased payments. To his point, like, people are going to see that increased payment, but it's interesting to see how the market has kind of responded to that over the last couple of years to kind of in anticipation of that change.
Yeah. And I think even those that haven't made those changes voluntarily, we talked about it. I just talked about it briefly. We've talked about it in the past. There are ways in which they can lower those or keep those payments around where they're at, even if their rate is doubling, going from the 189 to maybe a 399 or something like that. But instead of maybe being at a 20-year amortization remaining, or maybe now bumping it to a 22-year. And so that's helping to offset some of that cost or that increase to be at that same budgetary amount that they're used to or comfortable paying. And then having that, having the ability down the line to increase their payments voluntarily, which then kind of puts them back on that original path of, their amortization getting below that 20 mark or, 25 to 27, whatever it may be. But really kind of taking that time to go through that. Benjamin Tall's comments were more so just at if everyone kind of stayed at what they were at as far as like amortization or not doing anything with that mortgage and being up for renewal. So he was really kind of highlighting as well was a couple things. The numbers for population that that is out there or that people use is that we're a population of 41 million, but there's actually a whole million people that we're not counting for in the country and that we're actually in the 42 range. There's, Statistics Canada he commented that StatsCan just put out their official estimate for Canada's population as of second quarter 2025 was about 41.6 million. Again, I guess you can't be exact on those figures, but you'd think it would be, the fact that it's even about is even the terming it about and that we're off, that the figures are still off by a million is pretty funny. But what that leads to is just kind of in that demand for housing and where the numbers actually lie. And then we had the slowest second quarter growth since 1946 outside of the pandemic. So,
For
you
housing
know,
starts or population?
for
Sorry, for
growth. Yeah. Yeah.
yeah.
So his outlook for going forward, he's expecting that a tough housing market environment to persist for another 2 years. He thinks that there's possible for some recovery in the second half of 26, 27. He thinks it won't be great. It'll just be okay. So kind of keeping an eye on that. Obviously things can change though. That's based on our trajectory right now and how long it takes for any of these policy changes by the federal government, by the Bank of Canada come into effect to actually make a real impact, and also based on our policies right now and where we're at, and not so much at, we obviously have a November 4th massive budget coming out. What does that look like? How does that change things for the good, for the worse? Who knows, to be seen. But kind of on our trajectory, that's what he's looking at. So no, really, why does it matter? Like when somebody of Tall's kind of caliber describes the housing market as frozen and the broader economy as in a per capita recession, it signals caution for new originations, meaning new business, or whether you're a mortgage or real estate professional listening to this, or even for if you're a home buyer, new originations just means new people coming to market to purchase. Borrowers, like their flow of how and behavior of how they go about things will be cautious and frozen at the same time. And we've been seeing it, and we've talked about in the past of especially when we're talking about tariffs and that kind of holding people back. They might, they're delaying their purchases. Renewals becoming more challenging, especially as they kind of have that payment shock, especially for those first time home buyers that maybe were in a 3-year. They don't have that necessary, a big chunk paid off on their mortgage yet. And then the supply side of housing may change as builders react. So because the outlook looks weak as well for the next 2 years, people want to prepare, either, again, if you're in the market as a realtor or a mortgage professional, preparing your clients to be ready for shifts in dynamics. There won't be frenzied buying, he's saying. There's going to be more negotiating power for buyers, again, just because of that kind of frozen market, if you will. And then the potential for tighter lending conditions. So kind of holding back, whether that's a slower market or decreasing values, potentially banks changing their lending parameters, whether that be amount of down payment, whatever it may be. And it can also go the other way for stimulation. But his suggestion is really in rate cuts and tax relief, dropping those HST and HST and GST relief, and to really kind of help move that market along. But yeah, I mean, really kind of looking at the distinction as well, what you're looking at as a home buyer, between a low rise, meaning again, not a condo, being okay, or a competitive market in some areas, and a high rise segmentation. And so kind of, not generalizing the housing market as a whole, kind of looking at it of the different niches of the different product mixes, because they all, do change and function differently. And it's something that we've talked about in the past. So there's, he's saying the economy's under significant strain, with the housing industry facing its biggest test since the 90s. Mortgage and real estate professionals, it's not just a highlight. Think about, and home buyers, think about strategically positioning yourself. Different market segmentations and things like that, kind of, again, narrowing in on what you're looking at or what you're dealing in from a niche perspective, because it's going to be tougher in the market for the next 18 to 24 months. But that does also open up opportunities for some. So just kind of being ready and again, honing in on what you're looking at or wanting to do.
So what I'm hearing, Dave, is we're in a recession. Okay, rates are going down, prices are going down. What's next? One thing that I have heard from buyers, pre-approved buyers, is that they have said that they feel like they have a lot more negotiating power. They literally will send me a listing and then tell me, we think we can get it for X amount less than the purchase price. I've heard that from multiple buyers over the last couple months, saying it's listed at 700. We think we can get it for 665 or whatever. So it seems like everyone is looking for a bit of a price reduction, but also willing to wait for the price to match almost their expectations. So I think the sellers now have come to terms with the fact that they're not getting that 2022, 2023 sale price, but also now buyers are kind of hip, knowing that they also kind of hold the cards. They are not in a rush. A lot of sellers, in some cases, have to sell. I think we've come out of that wave, at least from what I've seen, of people that needed to kind of I don't want to say panic sell, but people that had to sell in, 2023, 24, whatever reason after the pandemic, tightening their budgets, et cetera. I think now we've kind of moved into the people that are, looking to maybe downsize, maybe looking for that lifestyle change. And the people buying are also kind of ready to go. But all of this, like everything you just said, to me, the speculation would be that, we're probably going to see further rate cuts and we're probably going to see prices come down even slightly over the next 12 to 18 months. At least in major, obviously, every area is different, just to be very specific. But I would say in Ottawa specifically, I can't imagine prices are going to increase by that, typical 3 to 7%, let's say year over year. I would imagine it'll probably stagnate a bit. I don't know where the numbers are this year. It'd be interesting to see at the end of the year where things stand because we're in October now. I mean, interesting to see what our predictions are. I think they're still up year over year. But I would say over the last few months, it seems as though every purchase agreement I see coming in is under the list price.
Yeah. Yeah, no, I agree. And to that point of, kind of on that rate standpoint, really we've seen that pressure from the bond market even recently coming down. But today, we're the 21st. The inflationary numbers came out today and was, slightly a little bit higher than expectations, which kind of put a little bit of a wrench into the bond market. It really caked in that there was going to be a drop on the 29th. This, kind of maybe put a little bit of a wrench in it. But so maybe you want to touch on that a little bit.
I would love to. I would love to, David. Thank you.
Fantastic. I don't think anyone wants to hear my voice.
Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker. So Canada's inflation rate rose to 2.4% in September 2025, which was up from 1.9% in August. It's a sign that the country's fight against inflation isn't quite over, believe it or not. The main culprits were higher food costs and rents, while gasoline prices didn't drop as much as they did a year earlier, creating a base effect bump. I will say, I want to cut halfway. I saw gas here in CP the other day at 107, which was the lowest I've seen it in years. Even Jackson was like, what? And then obviously now that he has a car, he's very conscious of the gas prices.
I also want to touch on you said gasoline, but anyways, continue.
Gasoline. Okay, shelter costs rose sharply, especially rent, and grocery prices are still running much hotter than the overall consumer price index. Economists note that while inflation has cooled dramatically from the 2022 highs, these core pressures should show that price stability isn't yet secure. With that data, the Bank of Canada faces a dilemma. Inflation is higher than expected, but the economy remains fragile. It might have to pause or delay further interest rate cuts until it's sure inflation is truly contained. Okay, key points. CPI rose 2.4% year over year, up from 1.9% in August. Food prices up around 4%, especially fresh vegetables and staples. Rent inflation surged nearly 5%, contributing heavily to shelter costs. Gasoline fell less sharply than last year, adding to the inflation uptick, and core inflation measures remain elevated, complicating monetary policy. So what do you think, Dave? Are Canadians actually going to feel this 2.4% inflation rise, or is it just a psychological shift more than a financial one? I feel like it's already priced in. Like everything is already priced in. Everything is already very expensive.
Yeah, I think it's kind of like you just touched on it too. it's those items that you on a daily basis see the difference of, that stand out to you, that you buy on a regular basis, like gasoline. Seeing gas prices being down in the $1.14, at least in Ottawa, the $1.14. You said you saw $1.07. That's something people buy on a regular basis, and so seeing that price comes down makes them feel better. But then they go to the grocery store and it's vegetables and meat that is the two elevated areas of consumption that for food costs that are elevated. And so you kind of have in people's minds, they're seeing like it's a kind of a really weird dynamic, because you're seeing gasoline you're buying on a regular basis being like down dramatically from basically $1.40, $1.50. Who would have figured that the that good old tax that was on there contributed, wasn't inflationary. But I digress. But then going to the grocery store on a weekly basis and seeing the higher food prices kind of really does, I feel like, mess with people's heads. Like most people aren't seeing rent, a rent change month over month, because they are currently renting. They're staying in their place, and the most that their rent is able to go up on an annual basis is kind of low 2% range, and that's only once a year. So it's not month over month or a change like that they're seeing. So I think it's kind of in those, like, to me, those two areas that people kind of right now are conflicted as to, is it more expensive? Is it less expensive? Like, kind of, at least to me, that's
yeah, I've noticed it too. I mean, this is obviously a very small microcosm, but even shopping at Costco, which is typically like much less expensive, or at least buying in bulk versus going to, your kind of local grocery store. But some of the things like even like 6 avocado now at Costco is $14, which is, quite expensive. A 4-pack of bacon, $30. And this is these are like Costco prices, not like, I know the grocery store now, a single pack of bacon is $10 or something, right? So like you do see it, those $2, $3 per item add up every time you go to the grocery store, when, you're spending hundreds of dollars a week, depending on the size of your family. I mean, it could be thousands of dollars a month just on groceries. That extra 4%, 5%, 10%, like, makes a huge difference to your bottom line, like as a household, And I agree. I think that's where people are feeling it the most, is kind of in those things that they have to buy, or it's part of what they buy. And they even said like vegetables, kind of those staples that you need in the house, like bread, butter, milk, like eggs, everything is more expensive than it was a year, 2 years, 3 years ago. Yeah, be interesting to see. I mean, the fact that he's announcing that we're essentially in I forget what he called it, per capita recession. I think it's like perfectly worded. I mean, we felt like we've been in a recession for a year, maybe a year and a half, but like nobody is really saying it publicly. It's kind of just like swept under the rug, like, no, everything's good. We're good. Look at everything. Everything's great. Look at all these jobs.
Yeah.
But, when it comes down to the bottom line of Canadians and Ottawans, we feel it, and everyone's feeling it. So, so it's great to hear it coming from the top down, what we already knew, but it's nice to kind of have those like specific numbers. And the inflation numbers came out today, and that's kind of, was a perfect timing as far as all this goes.
Yeah, we have there's obviously that rate announcement October 29th, but then we have the new federal budget coming out November 4th, which is kind of pegged, at least all indications are, that it'll be the largest budget in history by a dramatic amount. So it'll be interesting to see where that spending is and how that contributes to inflationary numbers as well, and how the Bank of Canada, has having to make a decision end of October prior to that announcement, whether they are cautious and hold off on the 29th, even though they feel that they should drop, because, again, like those families that you said that they're seeing that grocery costs go up, drop in bank prime or the overnight lending rate is dropping their monthly carrying costs of that debt, and freeing that up and allowing businesses to, spend a little bit more, and for, households that are on variable to save a little bit more monthly, where they're either able to put that extra on their mortgage, or they're able to, put into savings more. I don't think it's going to be that they're going to be going and buying more bacon. I don't think that's going to be I don't think a quarter point rate cut is going to mean that, that Joe Smith goes and buys, 5 packs of bacon instead of 1 that week, because he's got that extra quarter point in his of prime rate cut in his jeans. But I think they very well could hold off just because of the timing of the budget announcement.
So I know just from high level kind of research that I've done on the actual budget itself, I know there's a lot of at least proposed allocation to like defense and security investments. So, tightening up the borders, all the stuff that kind of President Trump wanted Canada to partake in, housing supply and affordability. The affordability and cost of living relief, like that's something that they've been talked about. Like, how do you see them rolling that out? Or have you read anything about like what is anticipated to be in the federal budget and what's kind of being allocated where?
Well, Paul, let's just skip ahead over talking about where the Gen Zs are losing jobs and jump into federal housing then. So exactly around that, they've been hinting at one area that I've talked about and I deal with a lot of construction clients and kind of in that space is looking at cutting development fees. Again, I've talked about in the past of how much it contributes towards building costs where it's the homeowners or home buyers that are stomaching this. So there's signaling a move toward reducing that and reducing the municipal development fees. So the Canadian Housing Minister acknowledged that development charges, the fees municipalities levy on new builds to cover infrastructures like roads, sewers, are a significant challenge driving up home construction costs. In his press conference in Toronto this past week, he said the government is working through that process of cutting those fees, while an election promise by the Liberal Party had been to cut municipal development charges by 50%. He stopped short of committing to that future outright. He indicated that details of how and when any reduction will come to be clarified on the November 4th budget. But Ottawa has already announced and committed $283 million through Canadian Housing Infrastructure Fund for sewage system upgrades in Toronto and that area, which is expected to open up the ability to build another 63,000 homes in that area. So, obviously you need the infrastructure underground be able to add housing. So it's kind of a little bit of a cart before the horse, so to speak. And then on the flip side, the Ontario Real Estate Association has outlined as part of this that development charges add upwards of $135,000 to the price of a new home. This changes by municipality. The $135,000 would actually be the Toronto market for development fees for like a single family home, that sort of thing. But when you're looking at, and I've talked about it, in the past of how high development fees are, it's not something that the builders are just eating themselves. Like this is getting passed along. So, you've got not just this, you're buying in Toronto market of trying to buy a single family home. That's, of $1 million average price point. That's 13.5% of that purchase price is development charges. But then also you're being charged HST or GST on top of that, compounding like onto that cost as well. All that's doing is obviously just driving up what home buyers are having to stomach and having to pay for. And there's obviously areas in which they use these funds for like infrastructure and things like that. But there's again, I'm not in that realm, but there's got to be ways in which we can, still cover the infrastructure costs of roadways and sewer systems and policing and things like that without, these outrageous costs. And whether it's, and it's a matter of is the focus on putting roofs over people's heads, or is it just mismanagement of spend by the municipalities and the provinces and federal side? How does it matter for new buyers? If development charges are reduced, it can mean that the cost components behind your new home gradually come down, and it makes new builds more affordable, more accessible. It's less capital because those development charges, I talked about it, I think last week in the last episode or the episode before, of some of the things that the Ottawa mayor put forward of reducing some of those development charges and things like that to the end. Well, when a builder is having to pay for that $135,000 upfront for one house, you multiply that over 1,000 on a where they're looking at developing, or even a couple hundred or 100 units. It's extensive. So it means that they're also limited from a capital perspective, how many homes they can actually build at one time. So it really kind of speeds up that building of those types of properties, for on home buyers, that's great. For professionals in our space, it's, lower development charges can stimulate more new construction, which is great. And and kind of looking at that new home, side of things. And there's that's kind of which is also for like first time home buyers, a great thing to look at of new builds, because there's less odds of something going wrong in them because they are that new construction. And then on the regional and municipal side of things, like charges are largely municipal or provincial tools. And the federal hint points to upcoming negotiations, or perhaps that national leadership can help with standardizing or capping those fees with the federal budget, as opposed to being left to just the municipalities to figure it out. So, it'll be really interesting to see what comes out November 4th. We have, at least in Ottawa, the mayor's put forward a plan as well with regards to a lot of changes around development fees and cutting some and pushing some to when occupancy is issued. So it'll be interesting to see as that rolls through on our, like in Ottawa, as that rolls through city council, how this November 4th, any of these initiatives actually impact things as well.
Yeah, I'm interested to see what time that comes out on the 4th, because we do record on the 4th. So maybe we'll look into it, David. Maybe if it's around 4 p.m., maybe we do a live Tuesday night session there with live. We haven't done a live show in years. But maybe we bring on someone who knows more about the federal budget than us and have them give us their 2 cents, But that'll be great. It'll be great. We'll cover everything. We'll tune in. We'll tune up. We'll be ready to rock.
Good. Well, speaking of tuning up, should we jump into some mood boosts?
We shall. I have 3 today, David. 3 boosts.
Hit me.
Number 1, you want to hear a pizza joke? Never mind. It's pretty cheesy. Yeah. Number 2, what do you call birds that stick together? Crows. No crows. I like that one.
Yeah, that's really dumb. I like that.
And number 3.
Kind of like me. I need those simple ones.
Number 3, have you heard about the pregnant bedbug? She's going to have her baby in the spring.
It's kind of clever, too. I do like that one.
2 for 3. I used that one like 4.5 years ago. It sounds familiar, but
I couldn't even tell you what you said last week. I put them out of my memory as soon as you say them.
This is why I'm reading the boosts. Thank you, everyone, for tuning in. Thank you for listening. Be sure to check us out on our socials. Okay, we got exclusive shorts on there, content, and thank you to our sponsors: Gerté Poirier Avocat Lawyers, Big Insurance in Westboro, Centum, and Easy Neon Signs. EasyNeonSigns.ca. Use the promo code TOREP and get 20% off each and every order. David, thank you for being here. Thanks for the insights. Go Jays, go!
Let's go.
See you next week. We'll see you next week.
Deuces.